Hello and good morning, listeners. Welcome back to Almus Market Mornings, your daily dose of global financial updates. I'm your host, Swaraj Rajagopal, and we have got you covered on everything from currency shifts to pivotal central bank decisions and important speeches. Plus, you'll gain expert analysis on macroeconomic data that's shaping the market narrative right now. Join us for this episode and navigate the markets with confidence. As traders in Western markets step away for Thanksgiving holidays, the US released a series of key economic data yesterday, including GDP, real consumer spending, durable good orders, weekly jobless claims, PCE, and the Chicago PMI. These data points provide valuable insights into the economic growth and labor market strength, metrics the Federal Reserve will use to closely monitor ahead of its monetary policy decisions. Meanwhile, President elect Trump continues to make waves even before taking office, triggering a sharp reaction in the Mexican peso with his latest post on trade negotiations with Mexico. Good morning, JK. Yesterday was packed with crucial data releases. What's your take on the numbers and their implications?
Good morning, Swaraj. Yes, first on the Mexico, even as market was teetering on the peso fall, there's a fresh tweet from Trump saying that they had a conversation with the Mexican official, and it's been agreed to stop immigration through Mexico and into the United States, effectively closing the southern border. And this is what he has tweeted. And immediately after that, we have seen Mexican peso actually recover more than 1% on expectation that US may soften the tariff. So actually, this is adding to the view that tariffs are this time being used more as a negotiating tool and will not be as threatening as it was earlier thought. So we'll see how this also goes on with the other countries, particularly China and Europe. Yes, as you said, we had a lot of clues on the inflation and state of US economy yesterday with a slew of economic numbers being released. The GDP second estimate for Q3 came as same as the advance estimate number one, and at 2.8%, with personal spending increasing at the fastest pace since Q1 of 2023. Although it was revised slightly lower from advance estimate, consumption happens to be a very large proportion of US GDP. Now, the consumer spending continuing to be strong is directly supporting the idea that inflation will remain sticky. And though not it's getting out of hands, the rate cuts happen at a much slower pace, is what we think. Then, of course, notwithstanding the overall consumption increase, the orders for durable goods actually rose only by 0.2% versus 0.4% that was 0.5% that was expected, and it also follows a revised 0.4% decrease. So I think consumption is restricted to more of essentials and not so much of the long-term durable goods. So that is something of a note on the consumption. On the inflation side, most of the parameters we got inflation numbers as expected. Of course, the expectation itself was that the headline year on year will increase by 0.2%, and also the core inflation year on year will go up by 0.1%. This had been well discounted, so it's not much of a reaction to these numbers yesterday. But yes, on the employment side, jobless claims again came at 213,000, 216,000 was expected. Lesser number of newly unemployed persons. And of course, continued claims remain elevated at 1.91 million. That means people out of jobs have continued to struggle, find new ones. So overall, there's nothing in the various numbers that we are seeing that worries us about the US economy, which is steadily holding strong. And with inflation likely to get a step up due to tariffs, Powell's latest statement that there is no hurry in cutting rates, something that we should agree with. In fact, the Fed minutes that was published on Wednesday also showed that policymakers were uncertain about the outlook on interest rates cuts and how much the current rates were restricting. Yes, we have seen the market discounting definitely for 0.25% on December, up to 62% probability from 53% probability earlier. But it also shows that in January and March, Fed will actually go for a pause. So that is the expectation on the interest rates. On the data side, we don't have much. Of course, Thanksgiving holiday and the Friday, we don't have anything real on the data front from US. There's no Fed speak or even the Treasury activities that are scheduled. Now, reacting to the data, there's not much that the bonds did because bonds yields were actually already lower, and a lot of month-end demand and short covering of positions helped the bonds recover. I would say the yields came off. 2-year came off to 4.19 and 10-year to 4.22, and these were earlier seen a high of 4.40 and 4.46. So a bit of buying in the bonds also helped by a good demand for 7-year new notes that were auctioned. Dollar also saw a partial unwind of huge longs the market has built after Mr. Trump's victory, where market has been expecting the inflationary policies to keep the yields elevated. Month-end flows also helping recovery in the currencies. As we would have seen, both yen and euro look the most oversold currencies recently, while euro gains have been limited because eurozone's problems are acute. Yen has made more solid gains held by narrowing yield differential with US. Also, expectations that the BOJ may hike in December. Not expecting much currency movement in the rest of the week as we enter the month end. I think more of a position driven, less of a flows. On the rupee also, month end demand saw the rupee weaken to 84.4750 yesterday. But the FISA flows were very negligible. We had seen large inflows the previous 2 days, and yesterday was nothing. And we enter the last month of the calendar year. This is December. What we look to see is whether the early allocations for emerging markets that usually happen with global funds will help the Indian market in the month of December. In any case, I expect 84.50 to hold the rupee weakness and wait for more cues in next week, rather next month, as we end the calendar year 2024. So expecting a quiet day today and possibly more action in the next month, first two weeks of the next month. Thank you.
Thank you, JK. And just quickly summarizing, US GDP second estimate for Q3 came in at 2.8%, similar to expectations. Consumption remains strong, as shown by consumer spending. Durable goods order rose slower than expectation. Inflation was mostly as expected. Both headline and core rose, so not much of a reaction to these numbers. Jobless claims was lower, but continuing claims remains elevated. Recent Fed sentiment, as shown by Fed minutes as well as Mr. Powell's statement, show that the Fed isn't in a hurry to cut rates. Currently, market is showing a pause in rate cuts for the next two meetings of next year, not in December, but of the next year meetings. Dollar and yields came off, helping the oversold currencies like yen and euro. Currency movement today, though, might be muted because of the holiday season that's going on. And month-end demand led to rupee weakening above 84.40. Markets will look for any early allocation of funds towards emerging markets, bringing some flows into India starting December. That's it from us today. Thanks for listening. Tune in tomorrow for the latest in the financial markets.